What is up, my people, my small axers, my love bugs? I hope you guys are doing awesome. 4th of July has passed. I hope you got some time with your friends, your family, your loved ones. And today, I want to talk about something foundational. I've been deep in the weeds lately, refining my multifamily deal analyzer, specifically the summary page. And it's really got me thinking about what you need, what should be on that page. There's a lot of numbers that we throw around in this business: IRR, cash on cash, equity multiple, DSCR, break even occupancy. All these metrics show up on offering memorandums, spreadsheets, investor presentations, and in conversations too. But how many people actually understand what these metrics are, what they're telling us, why we need to know them, etc.? More importantly, how many are using them to make smart, informed investment decisions? So, in this episode, I am going to break down all of this: why we invest in multifamily in the first place, what the key return metrics mean, which ones matter most depending on your goals, and how to think clearly about what your money is actually doing. So, let's get into it. Okay, but before we even talk about returns, let's take a step back. So, why do we even invest in multifamily is the first question we need to ask. And it's simple: we want to preserve and grow our capital. Multifamily real estate is a real asset, it's tangible, it produces income, and historically, it protects us against inflation. Very important to note. So, when you put your money into a building, you're not just hoping for upside, you're parking it in something durable, something that holds value. That's the first job for your money in this space: to preserve capital. The second job is to grow it through income and appreciation. But to measure that growth, we need to first have the right tools, and we also need to know what metrics we're looking at, what they mean, etc. It's important to note that we are first preserving capital. I said it like 3 times already, but it's so important. You have to preserve your capital, which means you have to have capital to start off with. Okay. That's another important topic as well. So, preservation of capital means that you have to start with something. You have capital, you have money that's going to be working for you. You're not just starting with nothing and building that capital. That's a different type of investment thesis and a different strategy. But for today's episode, we're just going to talk about your capital that you have working for you. Number one is to preserve it. Number two is to grow it. You have to keep that mindset moving forward. And let's start by breaking down the metrics that I include in my deal analyzer and what they actually tell us. Number one is cash on cash return, COC. This tells you how much money you're making each year relative to the amount of cash you put in. If you invest $100,000 and you receive $8,000 in distributions for that first year, it is an 8% cash on cash return. Simple. It's a snapshot. It doesn't include appreciation or back end profits, just what you're actually getting in your pocket annually. This matters for anyone who's focused on income and cash flow, especially LPs or limited partners. Cash on cash is one of my favorite easy metrics to understand, and hopefully you understand it as well. Number two is IRR. And IRR is the time weighted return across the life of the investment. It's basically what the annualized return is that takes into account when the money comes in and out. So it includes cash flow, refinance proceeds, sale proceeds. If you get your money back in 12 months, your IRR is going to be higher than if you got that same amount of money back in 24 months. Why does this matter? Because money today is worth more than money tomorrow. IRR helps us factor in the time value of money, which is crucial, because if you have more money in your pocket today to reinvest, you can grow that capital more. So, yes, you might have an overall return that is higher over the course of 5 years by a cash on cash basis. But if you get more of that money back faster, IRR factors in a different component, meaning the time value of the money. So if you have the money in your pocket quicker, even if it's less, you have the opportunity to reinvest that capital or to do something else, whatever you need to do or want to do with that capital. IRR is very important, although it's hard to calculate for us. Excel does it on its own. It's an extremely important metric that we need to factor in and know. So, in other words, if cash on cash is your now return, IRR is the whole picture return. IRR is one of my favorite metrics to look at. You should be looking at it as well. Typically, we're looking for over a 12 to 15% IRR when we're doing our calculations and making our spreadsheets. Number three is equity multiple. And this one is simple as well. It tells you how many times your money grew. If you invest 100K and you receive 200K total back, including profits, cash on cash, all of the returns, that's a 2 equity multiple, 2x. Very simple. This matters because it gives LPs and GPs a sense of total return. No fluff, no messing around, just output. So I really like to look at equity multiple as well. And a typical equity multiple that you should be looking for in your deals as an LP or as a GP is 2. And the thesis has always been, let's get double our money within 5 years. Investors have been expecting over the past 5, 6 years that I've been investing a 2 equity multiple. That equity multiple needs to be coming within 5 years. If you have a 2 equity multiple over the course of 10 years, it's not as appealing to most people as a 2 equity multiple in 5 years. Okay, so that's the goal. You should set that goal to have as an investor or as an operator. You want a 2 equity multiple over the course of 5 years. If you beat that, awesome. If you're a little bit off of that, it's fine as well. But you typically want to shoot for a 2 equity multiple in 5 years. And as far as cash on cash return goes, you want to look for anything above 5%. Basically, you just want to beat what the highest rate of safe investing is, like let's say a high yield treasury bond or even a high yield savings account. So you want to beat that for your cash on cash. Next up is break even occupancy. This tells you the minimum occupancy needed for the property to cover all expenses and debt service. If break even is 73%, that means if occupancy falls below that, the property starts losing money. And this is a risk metric that I love to look at. It shows you how much cushion you have in operations before you are in the red. Very important, because if you're in the red, you're going to either be tapping into your reserves or your own pocket. And in today's tighter cash flow environment, this number matters a lot. So what that means for us is we want to look for a lower break-even occupancy. A break-even occupancy of 50% is incredible. I'm typically somewhere in the 70% range, 70 to 75% range, maybe even 80%, but that's pretty high. You don't really want to have your break-even occupancy higher than 75% because you hit 75% sometimes, especially in this day and age, in this market. We've seen it all the time. And if you're running or managing smaller properties, and let's say you have a 4 unit, 1 unit vacant is 75%, and you're going to be at 75% occupancy for a month or two in today's environment, given the fact that it's challenging to turn units quickly, to get them done affordably, and to refill those vacant units quickly. It used to take days. Now it's taking 1 to 2 months, and it's unfortunate, but that's the way the reality is today. So if you're factoring in anything higher than, or if you're, when you're doing your deal analysis and you're looking at your deal analyzer and you're finding that maybe the break even occupancy is 80%, maybe you need to dial something back. What I would do in that scenario is obviously not change what the expenses are, because the expenses are the expenses and you're not going to be able to reduce expenses. Likely, I would reduce my purchase price or even my leverage. So you might want to bring more capital to the table and borrow less money from the bank, because remember, today's interest rates are 6, 7+ percent, right? So if you're borrowing 70% or 80% from a bank, you're paying a lot of money in debt service, and that's going to eat up your cash flow after paying expenses and after the NOI. So you're really not going to have much left over in your pocket. Just be careful. All right, the next metric that I like to look at is DSCR, or debt service coverage ratio. Some people call it DCR, debt coverage ratio. And this is the ratio of how much you can pay your debt. So for example, typical banks are going to be looking for either a 1.25 minimum to 1.35 debt service coverage ratio. And what that means is if your debt is $100,000, let's say, you have to have at least $25,000 above that in cash flow, or else the bank's not even going to lend on it. Okay, so debt service coverage ratio is your net operating income divided by your debt payments. A debt service coverage ratio of 1.0 means you're just breaking even, where the 1.25 means that you have 25% more NOI than you need to cover your debt, which is what I was just saying before. If you're paying $100,000 in debt, you need at least $125,000 in cash flow, or else banks will not lend on it. Some banks will go as low as 1.2, or if you're doing bridge, they might do even lower, like a 1 or even sub 1. But obviously, that's risky. It's tight, and you have to be very careful. You need to give yourself some breathing room, or else you're going to be coming out of pocket to pay that debt service, which obviously you want to avoid at all costs. Then we look at cap rate and yield on cost. So, cap rate is what the market says your property is worth based on your NOI. So, we always talk about this. It's a big topic in multifamily real estate that, yeah, multifamily real estate is valued as a business based on your NOI, yes, but the cap rates are dictated by the market, dictated by the buyers and the sellers, dictated by what people are willing to pay. In a volatile environment like we're in right now, cap rates are going to decompress, meaning expand, grow. So when you're purchasing a property at a higher cap rate, you're paying less for it. So the higher the cap rate, the cheaper the property is. The lower the cap rate, the more expensive a property is. Let's do a quick example of a cap rate. First of all, the value of your property is NOI divided by cap rate. So at a 5% cap rate, $100,000 divided by 0.05 is $2 million. In an 8% cap rate environment where we might be today, 5% a few years ago, maybe 6.5%, 7% today. Let's take the example of 8%. $100,000 divided by 0.08 is 1.25 million. So a 5% cap rate environment with the same NOI as $2 million valuation, an 8% cap rate with the same NOI is $1.25 million valuation. So you can get a deal today. Guys, this is crucial to understand. Cap rates have decompressed. They've expanded. So it used to be 5%. Now it's 6.5%, 7%. You can buy today at a 6.5%, 7% cap rate and get a steep discount. Okay. We also need to talk about exit cap rates while we're on the topic of cap rates, which is crucial. And many people fluff on this. A lot of people underestimate it. So your exit cap rate assumption is what you think the market will pay when you sell it. If you assume too aggressively of a number here, you're going to be lying to yourself and you're going to screw up your returns. So I usually underwrite to a cap rate that is higher than today's going in cap rate to build margin. Okay. So typically the idea used to be to expand cap rates 10% or 15%, 10 bips or 15 bips year over year throughout the course of the hold period. So if you were buying at a 5% cap rate, selling in 5 years, you would set your exit cap rate on your deal analyzer to 5.5. So taking our other example, if you're purchasing at a 5% cap rate, maybe you purchased it at $2 million valuation. Now, what are we saying? We're saying 5 years from now, it's going to decrease in value because the cap rate expanded 50 basis points. Yeah, you have to assume that because the market changes. You can't go in thinking that you're going to be in a better market a few years from now. However, it obviously happens because we all know that there are market cycles. But if you go in with that thesis, with that idea, you can be messing up and making big mistakes. You don't want to go in saying you're buying at a 5% cap rate and selling at a 4% cap rate. It's a huge difference. For example, you buy at a 5% cap rate. NOI is $100,000. You just purchased a building for $2 million. Now we're going to assume that the cap rate will expand 10 basis points year over year for 5 years, and you're going to sell at a 5.5% cap rate. That means you're selling at $1.8 million. What? Well, yes, but us as investors, we have levers. Okay. We're not going in thinking that the NOI is going to be stagnant or even decreasing. However, obviously it does. But us, you and me, as operators, we control the NOI to a degree, and we try to push it to increase the NOI. So at that 5.5% cap rate upon sale, our NOI might have increased to perhaps $125,000 instead of $100,000. So now we take that $125K NOI, divide that by our 0.055 or 5.5% cap rate to get a valuation of 2.27 mil. So you increased the value here, even though the cap rate expanded. Now, if the cap rate doesn't expand so much, Great, you're in luck. You still increase the NOI and you make even more money. Another thing to consider is that you are paying down the debt throughout this period. So, over the course of 5 years, perhaps you paid down, let's say, $100,000 in debt. That $100,000 is now your profit. And we're keeping this very basic. But once you sell at the new number of 2.27 and you purchased it at 2 million and you have another $100,000 in equity for paying down the debt, you just made about $370,000. That's basically how it works. Obviously, there's a lot more involved in it, but that's what you should be thinking as an investor, as a savvy person, as somebody who's going to rip apart and rock this multifamily space like me and you. Buy buildings, build empires, my fam. All right, putting it all together. So, which metrics should be front and center of your deal summary? Well, that depends on who's reading it. If it's for you or your internal team, you want all the risk and return indicators, cash on cash, IRR, equity multiple, DSCR, break even occupancy, cap rates. I even want debt yield, gross rent multiplier, et cetera, which we haven't spoken about today, but very important metrics too. I want to look at the 1% rule. I want to look at door price per door going in, price per door going out, what we're claiming we're going to get as a valuation on the sale as well. I also look at debt yield, which is very important. And it's a metric that lenders use to evaluate risk. It tells them how much income a property generates relative to the loan amount, regardless of interest rate or amortization. So the debt yield is the NOI divided by the loan amount. And this matters because if we had to foreclose, it's like, how fast can we get paid back? That's what the lenders need to know. Higher the debt yield, the lower the risk. I typically look for something above 8%. Anywhere from 9 to 10% is awesome. And here's a quick example. So the NOI is $150,000. The loan amount is 1.5 million. Let's say the debt yield is now $150,000 divided by 1.5 million, and it's a 10% debt yield. And lenders often want to see a minimum of 8 to 10%. Anything lower than that, they're going to consider it too risky. So just be careful of that as well. So I look at debt yield. I also look at gross rent multiplier. And the gross rent multiplier is just a quick way to estimate a property's value to compare deals based on gross rental income and ignoring expenses. Obviously, it's important to not ignore expenses, but here's just a quick snapshot of what you're looking at. It's kind of similar, in my opinion, to the 1% rule, which we're going to talk about in a second as well. But the gross rent multiplier, or GRM, is the purchase price divided by the gross annual rent. And we can reverse it too. Value equals gross annual rent times gross rent multiplier. So here's an example. If you purchase for $1 million and the gross rent is $120,000 a year, the gross rent multiplier equals $1 million divided by $120,000, which is 8.33. Now, this is faster than a cap rate valuation, but it's a little less accurate because it ignores expenses. It's useful for quick comps or back of the napkin analysis. What's a good GRM? Well, in my opinion, it depends on the market, obviously, in the market cycle, but you want at least a 4 to 8 GRM, gross rent multiplier, in cash flow heavy areas, and a 10 to 20 plus in expensive or coastal markets. And the explanation behind that is, well, the GRM reflects how much you're paying for each dollar of gross rent. So the range is driven by location, rent levels, and investor expectations. So the low GRM equals more cash flow. And you find this in like Midwest, Southeast, or the Rust Belt or tertiary markets. Now, properties are cheaper relative to rents. Investors expect higher cash on cash returns, but risk is often higher. Older properties, less appreciation, etc. So here's a quick example. A $600,000 building with $100,000 in gross rent gives you a gross rent multiplier of 6. Now, why would we accept a gross rent multiplier of higher, like 10 to 20? Well, these are appreciation markets. We're talking about coastal markets, New York, LA, San Francisco, Boston, or high demand metros. And property values are high, but rents don't scale proportionally. Investors accept the lower yield for future upside through appreciation, and it's often driven by institutional buyers, 1031 exchanges, or tight inventory. So you're going to get less cash flow in this area, but it's acceptable for those investors that are looking for something a little safer. Let's do a quick example. $2 million building with $120,000 in gross rent equals a gross rent multiplier of 16.7. So here's some key insight. A low GRM is an income play, cash flow. A high GRM is an appreciation or a speculative play. But it really depends on your market that you're choosing, the market cycle, and other factors. So cap rate, yes, is more precise than GRM, but GRM is a blunt but fast tool to understand how expensive a deal looks in a given market. It's important to look at too. Now let's quickly talk about the 1% rule because I use this all the time for my investments and just for analyzing deals in general. So when I'm quickly looking at a deal, if I'm going to pay $100,000 per door for a deal, that needs to be making a minimum of $1,000 in rent today, not future value. And honestly, I would probably today pay $80,000 per door that is getting today $1,000 in rent. Okay. It's just the way it is because expenses are higher and debt service is higher. So you need to cover your booty. All right. So let's backtrack again and put all this together. There's so many more metrics we can look at, but I want to keep it a little bit concise for today. And it depends on who's reading it. So if this is your internal team again, right? So cash on cash, IRR, equity multiple, DSCR, break even occupancy, cap rates, going in, coming out. You want to look at debt yield. You don't have to show your investors that. You want to look at gross rent multiplier, the 1% rule, etc. If it's for investors, you want something clean, something visual, and not too much clutter. You don't want to overload your investors with so much information, too many numbers, etc., that they're not going to really get. They want to look at it within 15 seconds and understand that this is a good deal for them and what they're looking for. And that's why I'm sitting here today, yesterday, every day, redesigning my summary page to make it look not only functional, but beautiful and powerful for investors, along with myself as a deal analyzer. I analyze deals every single day, guys, and I need to see certain things on my summary page. It really helps me understand what I'm looking at and then what levers to pull. Maybe it's price, maybe it's debt, maybe it's higher leverage, etc. And the metrics don't lie. They tell you the full story unless you don't know how to read them. And it's important, your job as an investor, to preserve your capital, of course, beat inflation, earn solid returns without taking on dumb risks. So you need to know what you're looking at. If you don't know what you're looking at, just educate yourself. There's plenty of podcasts out there. Use the metrics as a guide, guys, but don't be fooled by the big numbers. If people are projecting huge returns, maybe take a step back. Understand the assumptions, know where the risk is hiding, and build tools that help you become a smart investor, not just staring at pretty spreadsheets. And take into account that some people fluff their returns. Some people are going to project higher returns than they actually will or know that the property can perform as. So just be careful. You can always, either educate yourself or reach out to me. I would love it if you would hit me up, DM me, ask me questions. And if you're learning something here, share this today with someone that's stuck in deal analysis paralysis, or relying too much on other people's spreadsheets. Share this episode with them. If you're vibing with me, my fam, like and subscribe to this podcast, and I will catch you guys on the next one. Have an awesome week. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.